Quick question, do you know your credit score right now? Not roughly, not a guess. The actual number. If you just hesitated, you are not alone. Studies suggest the majority of Americans either do not know their credit score or have a significantly wrong idea of what it is. And that is a problem because this three-digit number quietly influences some of the biggest financial moments of your life. Whether you can rent an apartment, whether you get approved for a car loan, what interest rate you pay on a mortgage, whether a potential employer decides to hire you. All of these can hinge on a number most people have never even looked at. Today we are going to change that. We are breaking down exactly what a credit score is, how it is calculated, what the different ranges mean, what hurts it, what helps it, and how you can find out yours for free right now. Welcome to Yield Report Daily, where we break down personal finance in plain English. No jargon, no financial advice, just clear education you can actually use. Section 1. What is a credit score? So what exactly is a credit score? A credit score is a three-digit number, typically ranging from 300 to 850, that represents how reliably you have managed borrowed money in the past. Lenders, landlords, and sometimes even employers use it to make a quick judgment about how risky it is to extend you credit or trust. Think of it like a financial report card, except instead of grades for maths and science, you are being graded on things like whether you pay your bills on time, how much of your available credit you are using, and how long you have had credit accounts open. The most widely used scoring model is called the FICO score, created by the Fair Isaac Corporation. You also have something called a Vantage score, which is used by some lenders and free credit monitoring services. Both run on the same 300 to 850 scale, but they weight factors slightly differently. When people talk about credit scores in general, they are almost always referring to the FICO model. That is what we will focus on today. Section 2. The 5 factors. Here is the part most people never learn. Your credit score is not random, it is calculated from 5 specific factors, each weighted differently. Factor number 1 is payment history. This is the single biggest factor, making up 35% of your total score. Every time you pay a bill on time, it counts in your favor. Every time you miss a payment or pay late, it counts against you. One missed payment can drop your score by anywhere from 60 to 110 points, depending on how high your score was to begin with. This is why payment history is everything. Factor number 2 is credit utilization. This makes up 30% of your score. It is the ratio of how much credit you are currently using compared to your total available credit. If your credit card limit is $10,000 and your balance is $5,000, your utilization is 50%. Most experts suggest keeping this below 30%. Below 10% is even better. High utilization tells lenders you may be stretched thin financially. Factor number 3 is length of credit history. This accounts for 15% of your score. The longer you have had credit accounts open and in good standing, the better. This is why closing old credit cards can sometimes hurt your score, even if you are not using them. Factor number 4 is credit mix. This is 10% of your score. Having a healthy variety of credit types, things like a credit card, a car loan, and a mortgage, shows lenders you can manage different kinds of debt responsibly. You do not need every type, but having only one type can limit your score. Factor number 5 is new credit. This is the final 10%. Every time you apply for new credit, the lender does what is called a hard inquiry on your report. Too many hard inquiries in a short period signals to lenders that you may be in financial trouble and shopping desperately for credit. Each hard inquiry can drop your score by 5 to 10 points temporarily. Section 3. The score ranges. Now let us look at what the actual numbers mean. A score between 300 and 579 is considered poor. At this level, most traditional lenders will either decline your application outright or offer you credit with very high interest rates and unfavorable terms. This range usually means there are serious negative marks on your report, like missed payments, collections, or a bankruptcy. A score between 580 and 669 is considered fair. You can get approved for some credit products at this level, but the rates will not be great. You are considered a higher risk borrower. A score between 670 and 739 is considered good. This is where most Americans sit. At this level, you will be approved for most mainstream credit products with reasonable terms. A score between 740 and 799 is considered very good. You will get better interest rates and more favorable terms. Lenders actively want your business at this level, and a score of 800 or above is considered exceptional. Less than 20% of Americans reach this tier. At this level, you get the best rates available, the highest credit limits, and the fastest approvals. Everything becomes easier and cheaper when you borrow. The difference in real money between a poor score and an exceptional score is enormous. On a 30-year mortgage, someone with a poor score could pay tens of thousands of dollars more in interest than someone with an exceptional score for the exact same loan amount. Section 4. What hurts your score? Let us talk about the things that damage your credit score, because some of them will surprise you. Missing payments is the most damaging thing you can do. A single missed payment stays on your credit report for 7 years. Set up automatic minimum payments on every account so this never happens accidentally. Maxing out your credit cards is the second biggest mistake. Even if you pay your balance in full every month, if your statement closes while your balance is high, that high utilization gets reported to the bureaus. Try to keep balances low before your statement closing date, not just your payment due date. Closing old credit cards removes available credit from your profile, which increases your utilization ratio and shortens your average account age. Both hurt your score, unless a card has an annual fee that outweighs the benefit. Leaving it open with a small occasional purchase keeps it active. Applying for too much credit at once is a red flag. If you apply for 3 credit cards in 1 month, lenders wonder if you are in financial trouble. Space out applications by at least 6 months where possible. Collections are severe. If a debt goes unpaid long enough to be sent to a collection agency, it appears on your report and can drop your score dramatically. Even small amounts, like an unpaid phone bill or a forgotten gym membership, can end up in collections. And co-signing a loan for someone else means their payment behavior affects your credit too. If they miss payments, your score takes the hit just as much as theirs does. Section 5. What helps your score? Now for the good news. Here is what actually improves your credit score. Pay every bill on time, every time, even the small ones, even the ones you could easily afford to miss for a month. Set up autopay for at least the minimum payment on every account, so you never accidentally miss a due date. Keep your credit utilization low. If your total credit limit across all cards is $20,000, try to keep your total balance below $6,000 at any given time. Below $2,000 is even better for your score. Do not close old accounts unless you have a very good reason. Your oldest account and your average account age both contribute positively. Let them sit open even if you rarely use them. Become an authorized user on someone else's account. If a family member has a long-standing credit card with perfect payment history, being added as an authorized user can add that positive history to your own report instantly. You do not even need to use the card. Dispute errors on your credit report. Roughly 1 in 5 credit reports contains at least one error: a wrong account, a payment incorrectly marked late, a debt that was paid off but still showing as outstanding. Every error drags your score down unfairly. Disputing and removing errors is free and can make a significant difference. And monitor your credit regularly. You cannot improve something you are not watching. Checking your own credit score does not hurt it. It is only hard inquiries from lenders that affect your score. Checking your own report is called a soft inquiry and has zero impact. The link in the description below shows you a service that monitors your credit around the clock and alerts you to any changes, available for a $1 trial. Section 6. How to check your score for free. So how do you actually check your credit score? The most important thing to know is that you are entitled by law to a free credit report from each of the 3 major bureaus every single year. The 3 bureaus are Equifax, Experian, and TransUnion. The official government-authorized site to get these free reports is annualcreditreport.com. That is the only official site. There are other sites that offer free reports, but many of them require a credit card to sign up and will charge you if you forget to cancel. Your credit report and your credit score are slightly different things. The report is the full history of your accounts and payments. The score is the 3-digit number calculated from that history. The free annual reports at annualcreditreport.com give you the full report, but not always the score itself. For the actual score, many banks and credit card providers now show your FICO score for free in their mobile app or online dashboard. Check yours first before signing up for anything new. If you want ongoing monitoring that tracks your score in real time, alerts you when something changes, and watches for signs of fraud or identity theft on your report, there are dedicated services that do exactly that. The link in the description gives you access to one of those for just $1 to get started. Your credit score is not fixed. It is not a judgment of who you are as a person. It is a number that responds directly to your behavior, and behavior can always be changed. If your score is lower than you want it to be, the path forward is clear. Pay on time. Reduce your balances. Stop applying for new credit unnecessarily. Give it time. Scores improve steadily when the right habits are in place. If your score is already good, the goal is to protect it. Keep doing what is working. Check your report regularly for errors, and do not let small mistakes undo years of good history. Here is your homework. Today, right after this video, go to annualcreditreport.com and pull your free credit report. Look at it. Understand what is on there. If something looks wrong, start a dispute. If everything looks clean, set a calendar reminder to check again in 4 months. And if you want help understanding your score in more detail, check out our video on how to fix your credit score fast, linked in the description. It goes deeper on the specific steps to move your number up quickly. If you found this useful, subscribe to Yield Report Daily. New videos every week, personal finance in plain English. I will see you in the next one.